Last episode ended with a question about whether examining a broken system means anything if nobody's willing to choose differently. Today we're looking at the one document that answers that question better than almost anything else in American life: the tax code. By the end of this video, you'll know why a hedge fund manager can pay a lower tax rate than the nurse who treats your kids. You'll know why that's not a loophole anybody's hiding. It's written in policy, debated in Congress, and defended by lobbyists every single year. And you'll know why the payroll tax coming out of your paycheck is quietly doing the opposite of what progressive taxation promises. Let's get into it. It wasn't always like this. Americans are told the tax system is fair because it's progressive. The more you earn, the higher percentage you pay. That's the version most of us carry in our heads. It's also incomplete. The federal income tax wasn't built as a permanent obligation on every working American. It started during the Civil War as a narrow temporary tax on the wealthy, and it expired when the war ended. When Congress tried to bring it back in the 1890s, the Supreme Court struck it down, ruled it unconstitutional in 1895. It took a constitutional amendment, the 16th, ratified in 1913, to make an income tax permanent. And even then, it applied to a tiny slice of the country. Incomes above roughly $90,000 in today's terms, at a top rate of 7%. 2 world wars changed that. Automatic payroll withholding meant taxes came out before you ever saw the money. The tax base that was supposed to hit a few million wealthy Americans expanded to cover tens of millions of ordinary ones and never contracted back. That history matters because the code didn't become what it is by accident. It became what it is through decisions. And decisions leave fingerprints. The code nobody can read. The U.S. tax code runs to tens of thousands of pages. That complexity isn't an accident either. Every deduction, every credit, every preferential rate exists because someone, an industry, a corporation, a lobbying group, had the access to get it written in. A family filing a straightforward return captures the deductions they know about. A corporation with a team of tax attorneys captures everything the code makes available, including provisions that exist because that corporation lobbied for them. Complexity isn't a flaw in a system trying to be fair. It's the mechanism that decides who gets the benefits. The preference that proves the point. Here's the reveal I promised you. When you earn money by working, wages, salary, tips, it's taxed as ordinary income up to 37%. When you earn money from investments, selling a stock, a property you've held over a year, it's taxed as a capital gain, capped at 20%. That means a billionaire earning primarily through investments pays a lower rate on that income than a nurse, a teacher, or a construction worker pays on wages. Not a loophole. Explicit policy, debated in Congress, protected by the investment industry's lobbying power every time someone tries to change it. Deductions that work better when you have more. Deductions have a mathematical quirk most people never reckon with. They're worth more to people in higher brackets. A $10,000 deduction saves someone in the 37% bracket $3,700. It saves someone in the 12% bracket $1,200. Same deduction, same dollar amount. Dramatically different benefit, flowing to whoever already has more. The mortgage interest deduction works this way. So does the deduction for retirement contributions. We already saw how that provision got its start, back when we talked about the 401k. The pattern holds. The tax code rewards saving most generously exactly where saving is easiest, and gives the least support where it's hardest. The provision that shouldn't exist. If the capital gains preference is the biggest structural advantage the code hands to wealth, carried interest is the most egregious specific example. Carried interest is the share of profits hedge fund managers and private equity partners take home for managing other people's money. Compensation that can run into the tens or hundreds of millions of dollars, taxed not as ordinary income, the way your wages are taxed, but as capital gains at the lower rate. Economists across the political spectrum have argued for decades that this is compensation for services, not investment risk, and should be taxed accordingly. Multiple administrations have tried to close it. It survives every time, not because the economic argument for it is strong, but because the people who benefit from it have extraordinary resources to protect it. If that lands for you, if you've ever wondered why the loudest voices against raising taxes on wealth always seem to win, hit like, subscribe so the next video finds you, and send this to the one person you know who still thinks the tax code is just neutral math. The burden that falls flattest. The income tax has progressive elements. Other taxes baked into the system don't. Payroll taxes funding Social Security are capped. In 2024, only the first $168,600 of earned income was taxed for Social Security. A worker earning $50,000 pays that tax on all of it. A worker earning $500,000 pays it on roughly a third. As a share of total income, the lower earner carries the heavier burden, the opposite of progressive. Sales tax works the same way. A family spending 90% of its income on goods and services pays sales tax on 90% of what it earns. A wealthy family that saves and invests most of its income pays sales tax on a much smaller share. Add it all up: income tax, payroll tax, sales tax, property tax, and the system is considerably less progressive than the version in most people's heads. The gap nobody closes. There's one more layer: the cost of navigating all this. Wealthy filers get sophisticated tax professionals, and the cost of that advice is itself deductible. Lower income Americans are more likely to pay for commercial tax prep on returns that are often simple, more likely to pay for high-fee refund advance loans because they need the money before the IRS processes it, and less likely to know about free filing options. The Earned Income Tax Credit, one of the most effective anti-poverty tools in the federal budget, goes unclaimed by a significant share of eligible households every year. Not because they're ineligible, because nobody told them it existed. So here's the question this video actually leaves you with. Every provision we just walked through was written by someone, defended by someone, and survives because someone benefits from it staying exactly as it is. The tax code isn't neutral math handed down from nowhere. It's a policy document. And like every institution in the series, it's functioning exactly as built. The question was never whether the system is broken. It's who it was built to protect and who's been asked to carry the difference. Next time, we step out of the mechanics and into what all of this actually does to a household trying to hold itself together. Because understanding the machine only matters if you can see what it costs the people living inside it. Click the next video. Once you see what the squeeze actually looks like from the inside, you won't read a family budget the same way again.